Hi there, welcome to The Close. I'm Lindsay Biscaya in for Morella Fernandez today. Markets are closing in half an hour from now. So first, let's get to some of the other stories we're following for you in the BNN Bloomberg newsroom. In a speech delivered today at the Economic Club of Canada, Conservative leader Pierre Poilievre said U.S. President Donald Trump is wrong to attack Canada on trade and security. The opposition leader offered to work constructively with Prime Minister Mark Carney to advance Canadian interests. Despite the critiques of the U.S. president, Poilievre opted for a big-picture outlook and stressed the importance of long-term relationship preservation over short-term disputes.
Canada's prosperity and security are inseparable from a stable relationship with the United States. And that is why we should not declare a permanent rupture with our biggest customer and closest neighbor in favor of a strategic partnership for a new world order with Beijing.
Meanwhile, shares of Gildan Activewear are taking a hit today. The apparel manufacturer posted sales and profit in its latest quarter that beat estimates, but shares are being dragged lower by its 2026 targets. Its full-year outlook missed expectations for both profit and revenue growth, and analysts are also pointing to the decline in net income. Still, Gildan says North American demand for its products remains strong, with innerwear sales nearly tripling year over year. And Bloomberg is reporting that data center provider Equinix and the Canada Pension Plan Investment Board are nearing a deal to acquire At-North Holding for $4 billion US. According to the report, talks are at an advanced stage, and the transaction may be announced as soon as this week. At-North is an Iceland-based company that operates data centers across Iceland, Denmark, Sweden, and Finland. And we'll take a quick look at the markets here. The TSX is still up above 34,000 today after reaching a brand new record high yesterday, up by almost a full percentage point at the moment. If we take a look at markets south of the border, mixed trading today. S&P 500 is down currently by 0.5%. Dow Jones is basically flat, and the Nasdaq is down as well by more than a full percentage point right now. Well, the big story on the TSX today is, of course, another wave of earnings from Canadian banks. TD, RBC, and CIBC all reporting and beating estimates. And for more on their results, let's bring in Bloomberg's Christine Dobby. It's good to have you join us. Thanks so much.
Thanks for having me.
So I wonder, what's driving this broad-based kind of revenue surge across the sector that we're seeing?
Yeah, a very interesting set of results from all six of the big banks this quarter. They all beat analyst estimates, some more than others. CIBC had quite a significant beat, for example, today. But what we saw was pretty much broad-based revenue growth across all of their businesses. So this was a combination of things from higher market activity fueling trading desks and asset appreciation, really giving fee revenue a boost at wealth management businesses. But we're also seeing better results at their Canadian retail banking businesses and even at TD and BMO's US banking businesses. So really kind of an across-the-board theme of stronger revenue, despite the fact that loan growth has really not picked up, as well as expense management across the firms. And so the result is higher earnings and earnings that have exceeded analyst estimates.
I want to talk about loan growth a little more in a moment, but as you touched on, CIBC and TD, reporting really strong earnings as well as the other banks, but these two banks in particular, the shares hitting new all-time highs today as a result of these reports that are out. So what do you think it is that investors are responding to the most?
Yeah, I mean, for a lot of the banks, the chart has just been up and to the right for a while now. CIBC, this is, I think, they've had more than a 2-year streak of consistent earnings beats. So they're really becoming this no drama bank. Their results are almost predictable that they're they're sort of clean across the board. And at TD, we are seeing an improvement in return on equity, which comes after a very rough period for the bank. And we are seeing some positive trends at the United States business, where they are under an asset cap, but they've managed to make some room to continue to grow that business. So positive trends from them as well.
And what can you tell us about credit loss provisions? Like, should we view credit quality as stabilizing for now, at least?
Yeah, so I mean, a really different picture than what we were seeing a year or two ago, where credit losses provisions were what was driving a lot of the earnings volatility, and we were seeing a lot of earnings misses because of large provisions. They've been largely in line with analyst expectations for this quarter, at least. At RBC, they had good results and they beat analyst estimates, but they had slightly higher than expected impaired provisions due to some large. They tend to have some larger provisions on corporate accounts, and that could have been a contributing factor to their shares being down a little bit today. I think they're a bit flat at this point. When looking ahead, the banks are sort of saying this year still looks uncertain, but they're not expecting huge credit provision builds like we've seen in the past. So it really does start to feel like a more stable credit environment.
These strong earnings that we're seeing today and this week from these big six banks, like, what does this say, do you think, about the sector's momentum heading into the next quarter and just the full year ahead?
I think what they'd all love to see is the return of some loan growth. And one thing we wrote a short story on about RBC is, what are they going to do with their excess capital? They're sitting on quite a bit right now. And CEO Dave Mackay called out the fact that the government of Canada and Prime Minister Carney have all these ambitions for the country to engage in these major nation-building projects, to spend a lot on defense. Mackay saying RBC will be there to support the country in some of those opportunities, and that could be a way that they could deploy some of that capital. So I think what a lot of people would like to see is a return to more lending, which could really help boost the economy. And they are really well poised to do so if the opportunities should arise.
Okay, Bloomberg's Christine Dobby joining us live. Christine, appreciate your time. Thanks so much.
No problem.
Well, EQ Bank has reported their latest results, so we'll get more on that and how Ottawa's new fast-track fintech rules could reshape competition in Canadian banking. Stay with us. That's coming up next. Welcome back. EQB is out with its latest quarterly results, showing continued growth in its customer base and overall cost structure. At the same time, Ottawa's new fast-track framework for fintech licenses is shifting the competitive landscape as EQB moves ahead with its PC Financial acquisition. So for more, we were joined earlier by Chadwick Westlake, the CEO of EQB.
This is such an important time for the Canadian banking industry. And Canada's challenger banking is leading the way. And more competition, more choice for Canadians. We're very purpose-led, very intentful in trying to improve Canadian banking. So we're making great strides. And this was a quarter of doing what we said we were going to do. We said we'd improve efficiency as a competitive advantage. We improved almost 500 basis points in one quarter. We said we were going to improve ROE back to our 12% outlook for this year and back to our medium-term guidance. We increased ROE and EPS, to your point, almost 50% quarter over quarter. So we're making great financial strides, but also doing very important things for Canadians. And that's going to hit a whole new platform when we close the transaction with PC Financial and start our Loblaw partnership.
And we're going to talk more about that. But with the efficiencies to improve that, where did you find them? What were you doing? Yeah,
we had a restructuring late last year. So it was a combination of some people and process costs where we became more efficient. A lot of this comes down to focus. How do you focus your capital and your resources on the things that matter most and really spend time on that, because you can get distracted otherwise. So we're focusing on where can we make the biggest win for Canadians and for our company. And that's where some of those changes came in. So there was some reductions in staffing, and we thought through our balance sheet a little bit differently and focusing on where we can win. And that's the outcome of that.
And and when you say you rethought on your balance sheet, what were you doing? How were you rethinking things?
Yeah, there's some projects and some products where maybe we weren't winning. So we're doing a little bit less in some others and focusing on where we're number one. And that's the outcome of that. So we were doing a little bit less in things like insurance lending and some other products, a little bit less time there, more on our core franchise, our core single family, core reverse mortgages, core commercial banking, things like that.
And AI, where's that fitting in for you? I mean, it's what everybody is talking about, and 2026 seems to be the year that everybody's really implementing. Obviously, you're using it. Where is it fitting in? Yeah,
right across the board. We actually just, for commercial banking, we had a new commercial loan origination platform that we were doing a lot of work with that actually increased our start to finish time about 30 to 50% actually in the actual loan approval process. So it was all AI within that process for commercial loans and right across the platform in terms of how we're doing adjudication, our back office operations, all of it. And it's sort of what will differentiate you is not only the AI, but how you use that AI to become even more efficient and effective for customers.
Now, with the way your bank is set up, is it easier to implement AI?
Absolutely. So we're well over 90% cloud-based, 100% cloud-based in EQ Bank. We have an excellent partnership with Microsoft. We're based on Azure, and we actually have a very open API infrastructure that enables us to bring in fintechs and actually scale even faster with AI as well.
Okay, and going back just to talking about challenger banks and the opportunities, what opportunities do you see? Because I mean, there's not a lot of room anymore. There's just a few banks, and we've seen population stall. So where are you going? How are you building, and how are you growing?
Yeah, when we close PC Financial, for example, that will be one big step. So I think day one, we quadruple our customers. We nearly double our revenue. We add new distribution channels, and importantly, we then have PC Optimum that becomes part of all of our products. So we're going to have an opportunity to be more visible to about 17.5 million Canadians and bring in millions of direct customers. So we're going to make an impact there where they may not know EQ Bank today. So we're going to bring them our no-fee, low-fee products, our great digital platform, a lot more solutions we can bring to them. And you combine up this one new challenger. That's how we're going to make a difference. It's one of those things where if 80 to 90% of Canadians don't even know we're there today, with this transaction, they will. We have great products. We believe we have the number one products. We're going to bring them to those customers.
And where are you? I mean, I guess you're still waiting for approval, but how will you not step on each other's toes when you're bringing them together and not lose customers possibly because there's a lot of crossover and things like that?
Well, it's a net addition. So we're bringing in all that talent. This is about growth in Canadian jobs. This is about growth and options for Canadians. So we've set up an integration management office, and this is a partnership, Roger. That's really important. Loblaw will become up to a 25% shareholder in EQB. They're going to have a couple board seats. This is truly about partnership and aligning under this EQ Bank brand and PC Optimum. So we're very organized on that sense. And this is so aligned with the federal government's intent on greater competition and greater choice for Canadians. This is right on point. And I think there could be a lot of urgency to go even faster here. This is going to make more choice and better companies at the end of the day.
Now, they're fast-tracking the licensing framework for fintechs. I mean, where do you see that going, and what do you think of it?
I think that's fantastic. I think the more choice and more competition, the better, because that will drive the incumbents to improve pricing, products, innovation even faster. And that will get us to the table even faster to be visible, to bring more choice to Canadians. Every dollar capital we generate goes back into Canada. With this transaction, everyone has a job. This is about growth, truly, and choice. So we'd like to go faster, further, and make a big difference to Canadians now.
And what's the focus? I mean, obviously, PC is a big focus for this year. What else, though? Where are you hoping to take this? Yeah, well, outside of PC Financial, we're focused on our core franchise. So businesses like reverse mortgages, we just grew another 5% sequentially, and making a huge impact because there's actually not a lot of education in Canada about what that can do for customers. CMHC insured multi-unit lending is a big priority for us. Our single-family business, where we serve underserved, especially borrowers for self, that are very important to Canada. And our digital bank, EQ Bank, that platform, we just added another 26,000 customers quarter over quarter. And there's huge potential to continue to grow that. But you add it all together with PC, you have a very complete product shelf. So completing that product shelf is very important as part of this. And with the residential mortgages, are you feeling pressures there? Yeah, well, look, we reflect everyday Canadians. So you certainly saw there was some early delinquency, but that's very, very early, right? Actually, the portfolio is performing exactly as we expected. Even from last quarter to this quarter, we said we thought we'd see some improvement in PCLs. And we did. It improved 28% quarter over quarter. And our conventional lending for single family expanded another 2% quarter over quarter. So there's growth there, but we're not chasing growth. We're focusing on some key markets, especially like Quebec, for example. We had a great quarter.
So there is growth there, but people are struggling. You know, you have to reflect that, and the housing market is muted in its growth. But so we're choosing where we can win very, very thoughtfully.
That was Chadwick Westlake, CEO of EQB. Up next, we're taking a look at Warner Brothers' earnings and the continuous bidding war as Paramount ups its offer. Stay with us. Warner Bros. Discovery reported lower sales and earnings in the fourth quarter, underscoring the challenges the media giant faces as it weighs competing takeover bids. So for more on all of this, we're going to bring in Doug Kreutz, Senior Media and Entertainment Analyst with TD Cowen. It's good to have you join us. Thanks so much.
Thank you.
So looking at Warner Bros., it reported a wider than expected loss of 10 cents a share versus the 3 cents that most analysts were expecting. What do you think drove this miss to start?
Well, most people look at EBITDA when they're looking at Warner Brothers. There's a lot of kind of below the line items associated with the original Warner Discovery transaction that are complicated and not that interesting. And EBITDA was fine. I think the business performed largely as expected. Advertising was a little bit better at the linear networks. There's been some improvement in trends there. The studio, while it didn't have any movies in the quarter, earned a nice amount of money off its other content. And HBO continues to grow and see profitable success. I would also say that commentary for 26 was reasonably constructive, largely what we expected, although we had been worried that the studio might be looking at tough comps in 26 because they had a very, very strong film slate through most of 25, but they had said they expect earnings of the studio to be roughly flat. So, I think that the print was pretty good.
Okay, pretty good. Lower sales, though, lower profit. Like, is this maybe this is a one-off then in your eyes, or do you think this shows a deeper issue for the company moving forward?
Well, like I say, they didn't release any movies in Q4. That's sort of an anomaly. It's very rare that they have a whole quarter go by where they don't release any films. They'd had a very strong film slate for the first 3 quarters of the year. They also lost the NBA from their linear nets. So there was a lot of advertising revenue that was associated with that went away. But there were a lot of costs associated with that went away too. And we all knew this was going to happen. It wasn't a big surprise.
Mm-hmm. How do you think maybe the bidding war is influencing the stock at all, or is this more about the earnings that came out today?
Yeah, I think the stock is entirely being driven by the auction that's going on. I mean, the stock was at $11, $12 before Paramount first showed an interest, and obviously now we're up in the high 20s. Paramount, I think, ultimately will be the victor in the auction. While Netflix maybe would like to have Warner's assets, I think Paramount probably feels like they need to have them and need generally Trump's want. So I do think that Paramount, whether it's the current $31 bid or something a little higher, will walk away being the victor. Now, just because that happens, there's still a whole regulatory process that has to get cleared. And I think that's why the stock isn't trading all the way up to the $31 bid, because there's some chance regulators step in and stop the deal.
So do you think that investors, if they're looking at Warner Brothers right now, should they be looking more at what's happening with these bids on Warner Brothers compared to what's happening with earnings reports?
Yeah, I mean, if a deal unwinds for whatever reason, regulatory or otherwise, then Warner has to go back to being its own company and running its own business, and at that point, the fundamentals start to matter again. I think if you're in the stock right now, you're in it though for the bid and not for the fundamentals.
Mm-hmm. And I know you said you think Paramount is going to come out on top on this. What do you think is better for Warner Brothers as a company and for those who are maybe already invested? Is there a better outcome, Paramount or Netflix?
I think it'll either be Paramount or Netflix will walk away with a bid, whether it's 31 or it is the current bid, or 32 or 33. I don't think there's an outcome where Warner stock gets anywhere close to the low 30s without a bidder. So this is definitely the best outcome that investors can hope for.
And better, sorry, I should have clarified too, is this better than Warner being an independent company?
Well, for shareholders, probably yes. For the rest of us, I'm not so sure. I think having a diversified media industry is a good thing, and having it all rolled up into a few companies is probably not as good, but that's probably a bit above my pay grade.
Okay, Doug Kreutz, Senior Media and Entertainment Analyst with TD Cowen. Appreciate your time. Thanks so much for joining us.
Thank you.
Well, according to U.S. President Donald Trump's trade representative, Canada must agree to, quote, a certain level of increased tariffs and assist in reshoring American industries as part of any potential agreement. CTV's Mike Locouture has the latest on that front.
The State of the Union address?
Prime Minister Mark Carney says he didn't watch the State of the Union address, but there are impacts for Canada. President Trump made it clear tariffs are a key plank in his economic plan for the U.S.
The view of the American administration is that there'll be a price to access the American market. I think, every country of the world that I know of is paying a price. What I'm saying is that Canada is paying the lowest price.
But that price could be paid in jobs. The U.S. Trade Representative today making it clear this is about moving manufacturing back to America.
We really want to focus on reshoring here. We want to have production here. We don't necessarily want to be dependent on China, Canada, or anybody else for things like cars and that kind of thing.
The U.S. has 50% levies on steel and aluminum going into their country and 25% tariffs on autos. It's why the Canadian government is trying to diversify trade away from our American neighbors.
GM and Stellantis have been cutting jobs here in Canada. Well, we will look towards Koreans, we will look towards Germans, and we'll look towards Chinese investments.
While looking for other trading partners, Canada continues to work on saving the trade deal with the U.S. and Mexico.
The Canadians, I was in contact with my counterpart just this morning. He's going to come to town in a couple of weeks. They have a few ideas on how they might want to have a deal with us. We're obviously open to that.
By comparison, Dominic LeBlanc's office was far less committal. In a statement, a spokesperson for the minister responsible for Canada-U.S. trade would only say LeBlanc and Greer had a number of brief, informal exchanges in recent days about a potential in-person meeting in Washington in the near future.
Okay, that was CTV's Mike Locouture. Let's take one last look at the markets before they close for the day. The TSX probably reaching a new record high today. Yesterday, it closed at 34,127. It's above that right now, so it looks like we will be reaching yet another record high for the TSX. If we take a look at markets south of the borders, it's a different story for U.S. markets. Mixed trading today. The S&P 500 looks like it might finish the day down. The Dow Jones is up, but ever so slightly, basically trading flat. And the NASDAQ composite is down. A bit of a sell-off today as investors are a little worried after NVIDIA's results yesterday, and we'll be digging into that a little bit later. Up next, though, we've got the closing bells on Bay Street and Wall Street, so stay with us. We'll be right back. Here are the closing bells at the NASDAQ. Canton Strategic Holdings is ringing the closing bell at the New York Stock Exchange. AirCap rings the closing bell, and on the TSX, Jaguar Mining to celebrate the company's 10th anniversary of being listed on the Toronto Stock Exchange. You are watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on Bay and Wall Street. Okay, we'll take a look at markets, first of all, across North America. The TSX reaching a new record high yet again today. So we were continuing to watch the TSX above 34,000 now. It surpassed that point yesterday and even more so today. The S&P 500 is down, though, by 0.5%, and the NASDAQ also down by more than a full percentage point. If we take a look at some of the big market movers, Enerflex finished the day at the top of the TSX. This is a company that provides oil field services for natural gas and petroleum producers, and it's been at the top of the TSX all morning after their shares reached record highs on adjusted EBITDA beat. We're going to be speaking about that in just a moment. Cargojet, another company we're watching closely today, that stock soaring. It was close to the TSX to the top for most of the day as the share price was soaring today despite reporting earnings yesterday that showed tariffs really left a dent in its business. It finished the day up more than 6%. And then, of course, everyone watching NVIDIA, it's suffering its worst stock decline in 3 months today after the company's latest forecast appears to have failed to dispel fears of an AI bubble despite a really strong fourth quarter. You can see it finished the day down by 5.5%. As a result of what's happening with NVIDIA, chip stocks are falling today, including AMD. You can see it finished the day down by 3.5%. Broadcom is another example of a company that deals with chips that seems to be down by almost 3% to finish the day. And another one, just to give you an idea, is Micron, which is down by more than 3% to finish the day. And for more now, we are joined by Bloomberg's equities reporter, Stephanie Hughes, to break down some of those stocks. Stephanie, good to see you. So we'll start with Enerflex. As I mentioned, we're going to dig into the details of this. It reported last night after the bells. Investors are liking those numbers, I guess.
They are, Lindsay. Yeah, Enerflex shares gained by over 18% at their highest point, which brought the stock to an all-time high today. And it was also by far the best performer on the TSX for the entire trading day today, as that intraday boost was also its biggest in about 2 years. So this isn't a company we talk about very often. So just to fill viewers in, Enerflex is an oil field services provider, kind of helping natural gas and petroleum producers with products and services to ensure that they essentially have the infrastructure they need to operate. So the reason why Enerflex is gaining today is because of earnings. So it is Enerflexing its earnings, as it were, with its EBITDA, or earnings before interest, taxes, and other variables, coming ahead of what analysts were expecting at about $123 million. The revenue was also well ahead of what analysts were expecting. So that got some thumbs up and good commentary from analysts like TD Cowen's Aaron McNeil, who was on the channel earlier this afternoon speaking with Andy Bell. He had some rosy comments in a note this morning saying that his team continues to believe that Enerflex is uniquely deserving of a market premium because it stands to benefit from a boom in natural gas and energy demand, and it will benefit from the financial performance that comes with it. So as well as that, it's been a massive driver in shares today, but it's also building on that big rally of over 170% over the past year. So it's been a good day for Enerflex, and clearly it's been on a roll, Lindsay.
Yeah, for sure. Okay, we're going to stick with earnings here because Northland Power's sales came ahead of what analysts were expecting as well. How is that stock reacting today?
Yeah, so it's another gainer, an earnings-related gainer. Those shares grew by over 8% at its highest point, which was its biggest gain since March 2020. So just a month shy of being nearly 6 years since we've seen a move of that magnitude. That's because the utility company's adjusted EBITDA and sales came ahead of what analysts were expecting. And on top of that, the EBITDA forecast for the year was well ahead, as the company now expects as much as $1.65 billion on the top end of that range. Even the bottom end of that range came ahead of what analysts were looking for. So the team at National Bank had some good things to say. They said that this was a resilient fourth quarter to cap off a volatile 2025, and that the guidance for the year was a driver of that narrative. So despite that 2025 volatility that National Bank was kind of alluding to, the stock was actually doing well over the past 12 months. It's gaining by, or has gained by, nearly 60% in that time span. A lot of that included 2025. So these gains are kind of moving Northland Power into further into the right direction for the company, Lindsay.
Yeah, it's interesting to watch those gains. Okay, that's Bloomberg's Stephanie Hughes reporting live for us. Thanks, as always, Stephanie. Well, up next, the S&P and NASDAQ closed lower today, despite NVIDIA reporting better than expected earnings. So we will break all of that down when we come back. Stay with us. Investors sold chip stocks today and shifted to software companies, even though NVIDIA reported a much stronger earnings quarter than Salesforce. So let's get more from Amanda Agati, Chief Investment Officer at PNC Asset Management Group. It's good to have you join us. Thanks for your time.
Thanks so much for having me.
So what do you think's happening here as we're seeing investors kind of shift their focus, especially after what NVIDIA reported yesterday?
Yeah, I have to say it's a little frustrating considering how strong Nvidia's result was last night. Is it ever going to be good enough? I think is the key question. And the challenge in answering that is when you're trading at a forward P in excess of 40 times, it doesn't leave a lot of room for mixed feelings about guidance. Even though the results were strong and guidance was strong, it's a market where Nvidia is effectively being priced to perfection. And so I think there is some investor disappointment there. But this is a little bit what I would describe as sort of natural and healthy recalibration in a market that's been only focused on Nvidia or even the Magnificent Seven for a multi-year period now. Like, we can recalibrate against some of these lofty valuations, and it doesn't mean the story is over. It's just sort of resetting, I think, the bar a bit in terms of investor expectations. We still think it's very early innings, and there's a lot of upside to go. I just think in the short run, there's a lot of noise around who's going to be the disruptor and who's ultimately going to be disrupted.
I like how you said that healthy recalibration. It sounds as though that might be something the market needed. Do you think investor reactions, though, like despite these earnings results from NVIDIA, are influenced by concerns that these stocks appear overvalued as well? Like, is that part of it?
I think it has to be a natural part of the conversation. I think the biggest challenge that I find with investors thinking about like what the right P, the quote unquote right P multiple should be for these exposures is you have to be really creative about what the future is going to look like, right? There's so much money going in terms of CapEx right now. We haven't really seen material returns on invested capital coming back yet. What are the new business models? What are the use cases? What are the fee, revenue generating models that are going to be built off all of this infrastructure? And so I think it's very hard for investors in this moment to think creatively about the future. It's sort of like we're very myopically focused on the here and now. And in order to justify these, more elevated, not bubbly, but elevated valuations, I think you have to kind of see into or get creative about what the future may hold.
When it comes to the software sector, it's been through a bit of a rocky ride since 2026 began. Do you think it's kind of reached its bottom now and we'll start to see some growth from here? Or what do you think is happening there?
I'd love to say that we're at an inflection point there. I think it's still a little bit uncertain. I would describe as maybe purple hazy as it relates to the outlook for software, because we still don't know yet who the winners and losers are in terms of this AI, automation, robotics sort of revolution that's happening here. What's going on in the short run is investors saying, well, software's in the crosshairs. They're clearly going to be disrupted. I'm not sure that that's the right answer. It's sort of throwing the baby out with the bathwater all at once, right? Again, very myopically focused in this moment. So I don't think software stocks go away. I don't know that, PE multiples need to stay where they are. I think they've been unfairly punished here. But I don't think that the entire industry or sector or cohort is necessarily going to look the same a few years from now as it does today. And I think it's the natural part of this technological and innovation related cycle.
I mean, that was going to be my next question. Like, are these fears about AI disruption over exaggerated? Because really, when you look at like the software sector, financial services, cybersecurity, private credit, there's fears within all of those sectors. So you think maybe they are a little over exaggerated, if I heard you correctly. Is there going to be winners and losers within each sector?
I do think that there will be winners and losers in each sector. I do think that some of the near-term noise and some of the resets that we've had are a bit overdone. That being said, the whole point of this is disruption, right? So to think that we're going to have all of this innovation, all of this investment go into effectively Web 3.0, right? This is sort of the second coming, or maybe third coming, as it were, relative to when we started to see Amazon and Uber and Lyft come on the scene from Web 2.0. This is the next iteration of it. AI, automation, robotics. I throw blockchain technology in there too. It's that next iteration. And I think it is going to be highly disruptive, but in a good way, right? Again, winners and losers. It is going to have implications for the jobs market. There's no question. But we need to think about embracing, I think, a lot lot of this disruption and figure out how to solve for some of those pieces of either the economy or the market that get disrupted. I just think it's early yet. We haven't quite figured out what all those pieces will look like.
Just in our last minute here, you mentioned that companies continue to pass on higher prices and expand their earnings margins. Where are these efficiencies coming from?
Well, I think in general, as a function of Q4 earnings season in particular, we were pleasantly surprised by the margin expansion really across the board. So it's not just about one name or 7 names. We're seeing not only broader participation in terms of, the names in the S&P 500, but also market breadth just in general in terms of the underlying fundamentals. So it's not one, particular sector or industry. It was really a broad-based theme. And I think it's, companies getting creative around how to drive operating leverage, and that they can pull a bunch of different levers in this, but also a piece of it is still being able to pass at least some of higher costs on to consumers. The consumer continues to hang in there, despite being through the ringer over the last few years. And so there is going to be a point where I think the consumer is going to say enough already, but we did not see that show up in Q4 results.
Okay, we'll leave it there. Amanda Agati, Chief Investment Officer at PNC Asset Management Group. Appreciate your time today. Thanks so much for joining us.
Thank you for having me.
Coming up, Quebecor beat on revenue and adjusted profit in its most recent results, and we've got more from the CEO about what's driving these results. That's next. We've been watching shares of Quebecor today after the Montreal-based telecommunications company posted results and mobile subscriber growth that beat analyst estimates. And for more, we were joined earlier by Carl Pellado, President and CEO of Quebecor.
After the Freedom Mobile acquisition that took place about 2 years ago now, we've been able to create pretty interesting momentum. I would say that, basically it's we've been able to follow the lesson we applied when we started in the wireless business in the province of Quebec. And we've been successful because we offered, what the customer was looking for, which was customer service. And I think that for the 15 consecutive year, we've been #1, and this is certainly something that position ourselves as unique, but also with pricing, innovation, and this is what we've been able to achieve. First, as a quote-unquote classical wireless operator with Videotron, but then we launched the first only digital wireless service under the brand of Fizz. There's no such a thing like a call center. You go on the internet, you dial what you're looking for, you pay, and you will receive your phone will be activated. So again, we've been applying this formula, this winning formula, in the different other markets that Freedom Mobile was servicing. Unfortunately, at that time, since Shaw acquired it, and as we all know, they decided that they would not like, the Shaw family to continue, and then the Shaw-Rogers transaction took place. But under the Shaw management, and in fact, this is what Brad was saying, and it's true, it's expensive, it's capital intensive, this business. You need to be ready to invest to make sure that your network will be able to follow what the quality of the service you'd like to offer to your customer. Okay. So that was an opportunity for us, and we invested, obviously, and we will continue to invest to make sure that the quality of our network will improve day after day.
I was going to say there's some analysts arguing that the CapEx is going to have to increase over the next couple of years, especially areas like BC, Manitoba. Do you intend to spend more?
No, we will continue on the trend that we've been able, we invested in the past. We shouldn't hide the fact that, we've been helped by the regulation. I said, because if you go back, in 2008, they decided that they were looking to have competition in Canada. So there were kinds of rules that will give the opportunity for new entrants, to come in the marketplace. We did it in Quebec by buying spectrum, what we call set-aside spectrum. We built, we start building. We went after as a MVNO. And today, we have the roaming environment, so we have the capacity, to roam or to use other operator network, obviously not for free. They charge for us, so we're able to offer a national service and international service also by having deals and packages with other international operators. So we're not forced, to invest. So it's a balance between investing on our new network and using roaming. So we do not have a need to do it other than to respect our obligation that we took with ISED, which is the industry minister department, and for which we bought spectrum. So we're not forced to get crazy. We have the capacity to continue to invest, and we will continue to do it.
Does that mean that if you're going to invest at a fairly consistent level, free cash flow, are we going to see share buybacks, dividends, acquisitions? Where are you heading with it?
Well, this year, we were able, to get more than $1 billion of cash flow. Free cash flow is, the EBITDA minus the capital expenditure, minus the interest that you're paying, and minus the income taxes. This is the cash available for distribution. Then how will you distribute that? You can reimburse your debt, and this is what we've been doing. You can repurchase shares, and this is what we've been doing. And you can pay dividend, and this is also what we've been doing. In fact, the board of directors announced in the press release this morning that we are increasing the amount of dividend paid per share by 15% because we have the capacity of doing so. The payout that we have on our EBITDA, on our free cash flow, is about 35%, and we a few years ago mentioned to the market that we will pay, our payout will be between 30 and 50%. So the bracket we're really in the middle of it. In fact, a little bit lower than the average, so closer to the lowest bracket, the lowest side of the bracket. So we do not have any problems, to continue to pay dividend, and eventually, given our policy of the bracket I just mentioned, to increase it in the future.
I just want to get in one more question about media. Revenue's up 23%, but that's a lot of that is because of that retroactive carriage fee settlement. Otherwise, your sports and entertainment down about 16%. Concerns about all that going forward?
Not really. Obviously, television and broadcasting is an issue everywhere in the world, and is an issue in Canada. You know probably because you're in this business, but we watch. You just have to watch what's taking place with Bell Media, with Chorus. The advertising revenues are down significantly. Subscribers also, because cable is not a growing business. In fact, it's a declining business, and therefore the subscriber base is an erosion, every day and every month. So we need to work on expenses, and this is what we've been doing for the last 18 months. It's unfortunate, because, people, some people lost their jobs, but, we need to make sure that, the rest will continue to live and to prosper. So this is what we're doing. And for sports and entertainment is really small in the overall revenue base that we have.
That was Pierre-Carl Palladot, President and CEO of Quebecor. Well, shares of Gildan are under some pressure today after the company posted lower than expected targets for 2026. We'll break that down when we come back. Stay with us. TD Bank posted profit in its latest quarter that topped estimates, as well as revenue that jumped 18% compared to the year before. TD also saw record revenue in Canada, helped by a rise in loans and deposits and strength in its wealth management and market segments. The quarter was also boosted by a decline in the lender's provision for credit losses and higher banking revenue in its U.S. division. CIBC's first quarter results came in higher than expected. Meanwhile, profit topped estimates, and the lender also posted better than expected results in its capital markets business. There was also record revenue across all of its units, as well as higher return on equity. Now, this marks the second straight year CIBC has beat expectations as the broader banking sector continues to see strong growth across multiple segments. Speaking of that, the Royal Bank of Canada posted first quarter profit that beat analyst estimates, driven by gains in its personal banking and wealth management segments. The bank also reported growth in its capital markets operations. RBC says it expects economic growth to remain positive despite heightened international trade uncertainties and forecasts modest growth in the first half of the year. Canadian Utilities posted net income in its fourth quarter that fell short of estimates and also missed on revenue. The energy and utilities firm says the results stemmed from regulatory issues as well as the wind down of a 2024 efficiency program. There was also a write-down of assets in its Alberta portfolio after repeated power curtailments due to weakness in the province's electricity grid. Shares of Gildan are seeing some pressure today after the Montreal-based company posted a full-year outlook that missed expectations. And to break it all down for us was David Schwartz, senior equity analyst at Morningstar.
The acquisition of Hanes Brands closed on December 1st, and most analysts, including myself, did not have any contribution from Hanes in the fourth quarter because the deal closed actually about a month earlier than expected. And so Gildan threw a lot of numbers at us this morning, and it was difficult to actually see how the quarter went, but it looked like it was a little bit soft, primarily on the innerwear side. But it doesn't really matter anymore because the acquisition of Hanes Brands is really much more important than the earnings in the quarter and also the outlook for 2026 and beyond. And so that's what people are really focused on. The stock price has been up a lot in recent weeks as people have tried to assess the value of Hanes. And it has dropped a little bit today, but I didn't see much bad news in the quarter. I think everything is actually progressing quite nicely. The company made a number of announcements this morning about its plans for the Hanes acquisition, including closing 2 of the acquired plants and expanding Gildan's existing facility in Bangladesh. So there's a lot of things going on right now. And so I think maybe people are just a little bit confused as to what the guidance is and also how the quarter went.
All right, and so does it seem like that the acquisition is going smoothly, or are there any bumps? Are there any bumps appearing?
I think it is going smoothly. It just started. It's only been a few months since it closed, and so there's a lot of work to do. Gildan did warn us this morning that there might be some supply issues this year because, as I mentioned, they're actually closing 2 of the plants they acquired from Hanes Brands. I think people maybe were a little bit concerned about that because it does suggest that there could be some product shortages that could affect sales. However, Gildan's management suggested it was really just going to be an issue of lower inventories, not a problem with actually fulfilling orders. And so we'll see how that plays out. But it really doesn't matter that much in the long run. It's really much more important to assess how the acquisition goes over the next few years. Gildan this morning said that they would have about $250 million in annual cost savings from the acquisition, which is more than the original $200 million that we were told last year. So from Gildan's perspective, it's actually progressing a little bit better than expected in terms of cost savings and integration. But there's no doubt that it's a complicated process because Hanes was about the same size as Gildan, and so essentially Gildan just doubled in size. The company's never done anything like this before, and there's always a risk with the integration of a large acquisition that there could be unforeseen complications in many different ways that affect supply of products and also customer relationships and other things. But so far, anyway, it seems like the deal is progressing as expected, and I think it was a great deal for Gildan. I think it paid a very fair price price for Hanes brands, and that over time it will create value. My fair value estimates on Gildan are well above the current stock price. $93 on the U.S. shares and $128 on Toronto shares. So I think it was a strong acquisition for the company.
All right, and they're selling the Australian business, the Hanes brands Australian business?
Yeah, that's right. So Hanes had a very large business in Australia. It's the market share leader in the country. But Gildan's management decided that it didn't really want to be in that business anymore. And so it did announce this morning that the business would be sold. The Hanes Australia business does about $675 million a year in sales. I think it could be sold maybe for $700 million or something. And that would be an unexpected cash infusion for Gildan, which would allow the company to retire debt more quickly because it did take on a considerable amount of debt when it acquired Hanes brands. So cash from that deal as well as cash generated from the business should allow it to pay down that debt pretty quickly. But I think there has been some concern about that.
And would that be their focus then for sure, is the debt pay down?
Yeah, Gildan right now has put stock buybacks on hold. It still pays a relatively small dividend, but most of the cash is likely to go towards debt pay down. Gildan said that it will get its leverage down to 1.5 to 2.5 times. And I think that will happen pretty quickly, possibly even by the end of this year, because Gildan historically has not operated with much debt. Hanes has long struggled with excessive debt, but Hanes was actually making progress in reducing its debt before the acquisition, which is one of the reasons why it was more attractive to Gildan. And so, I think that process will continue and that Gildan will get back to having a very strong balance sheet very quickly.
And no concerns that Gildan might pick up the bad habits of Hanes with the debt?
No, I don't think so. Hanes' problems really go back many years. Between the 2013 to 2017 period, Hanes made a number of acquisitions, most of which failed, to be honest, and most of which have since been sold off. Now, the Australia business, which Hanes still owned and now Gildan owns, was a successful one, just that Gildan decided that it's not strategic for them, and so they're looking to sell it. But I don't expect that Gildan will be making any acquisitions anytime soon. The Hanes deal is by far the biggest deal Gildan has ever made, and I would expect that all the efforts would be towards integrating Hanes brands into the business. And where do you see potential growth then over the next little while for it? There's potential growth in terms of market share. Hanes had long underinvested in its production, and Gildan is very strong in its production of basic apparel. And one of the big benefits to Gildan is that it can apply those processes to the acquired Hanes business and potentially bring down costs, which would allow the Hanes brands to gain market share. Gildan historically has not been successful in building its own brands, but Hanes still has very strong market-leading brands. It's still #1 in men's underwear, for example, in North America. And Hanes has been gaining share over the last few years. And so with Gildan's production processes and Hanes' strong brands, it creates a stronger business for the branded business. And then on Gildan's printwear, Hanes was a competitor in printwear as well. So Gildan bought a competitor there, which should allow Gildan to gain market share in the printwear operations as well.
David Swartz, senior equity analyst at Morningstar. Okay, we've got some breaking news that we want to tell you about right now. Warner Brothers has notified Netflix that its board has determined that the Paramount Skydance proposal constitutes a, quote, company superior proposal. So under the terms of this Netflix merger agreement, this notice triggers a 4-day business day period during which Netflix now has the right to propose revisions to its offer. The revised Paramount proposal, meanwhile, values Warner Brothers at $31 a share. Despite this, the board for Warner Brothers continues to be in favor of the Netflix transaction and has not withdrawn or modified its recommendation. So we will keep following that for you, but those are the latest developments we're learning about this afternoon. Up next, are we underestimating the risks behind the AI boom? One market strategist says the real flashpoint may be the electricity that's needed to power it. We'll tell you why right after the break. Should we be worried about AI-related capex? Our next guest says the rapid build-out of AI infrastructure could actually be inflationary and that electricity itself may become a political and social flashpoint. Joining us now in studio is Stephen Harvey, Chief Investment Officer at Sagard Wealth. It's good to have you join us in studio. Thanks for being here.
Thanks for having me.
So I guess maybe there's two options here of what could happen in terms of this demand of power that we need, right? Like one could be that there's more opportunities for utility and power companies, but as you say, this could also cause some political issues. Which way do you think we're going to go?
Yeah, I think that the market's already telling you some of the things that have happened so far this year. If you look at the best performing sectors in the US, for example, utilities and industrials are right there. It's all AI related. AI build out and AI's demand for power is there. Now, on the political side, you saw Trump bring it up in his State of the Union address 2 nights ago, in saying that there may be policy come in to make sure that these hyperscalers, when they're buying power, they're buying it off the grid. So therefore, the average citizen, average consumer is not paying inflated prices for power.
Is that a good idea to do that? And what Donald Trump said, where these tech companies should be the ones paying for the power they use?
It's already happening.
Okay.
You just look at the way these hyperscalers are sourcing their power. They're certainly not buying it off the grid, and they're not relying on being able to access the grids. You see some of the deals that Microsoft did with Constellation Energy, for example. Look at some other power generation companies in the US. They're doing direct deals, and they're building their own power plants exactly for these data centers.
Let's turn to defense spending. There's another big conversation right now in Canada, of course, because the GDP for the 5% of GDP is going towards defense spending now for Canada. They've upped that goal. You've called this an attractive long-term theme. Why do you think that is?
Yeah, and if you just follow where all the money is going today, the capital expenditure by companies is going into AI, and governments are spending a lot more on defense. And as a world, we're becoming a little bit more isolated and focusing on our own security. And I think what's quite interesting to think about is every country is probably going to have to spend money on their own security champions. So here in Canada, you could see more of a defense industry break out and be funded by the Canadian government. You're likewise going to see the same thing in Europe, Japan, Korea, and the US as well. So many different ways to play that.
A good time to invest maybe in companies that are going to be involved in defense?
I think so, and you're starting to see, like you saw it last year with the European breakout in some names like Rheinmetall, which is the largest German manufacturer of tanks, for example. Okay. This when the Germans announced a big fiscal surplus, like increase in their budget, which is the biggest spending in Germany since the reunification of Germany. That was largely around defense, and you saw those stocks react really quickly, but they're still reacting today.
Interesting. Okay, so moving on, your team launched an inflation protection solution in 2025. How's that going? I guess tell our viewers what that is for those who maybe don't know.
Yeah, so we work with many families and foundations across Canada, and what we're really trying to do is preserve their wealth. And how do we do that? What's the one thing that eats away at their purchasing power over time? It is inflation. So we've built an inflation solution for them, which is real estate, infrastructure, commodities, and gold. And each of them has a different attachment to inflation and a different way to win in an inflationary environment.
Okay, so how's that going so far since you've launched it in 2025?
Yeah, our goal there is to beat Canadian inflation plus 4%, and we're scoring way above that. So it's worked very well. Obviously, gold has been the story, but you've seen other commodities break out. There's been some great opportunities in real estate. For example, we've just invested in Japanese real estate, which is a very unique opportunity. And then infrastructure is a very slow, steady source of return.
You mentioned gold, so I want to talk about that more. Can you explain how it can protect people against inflation? Yeah,
one of the biggest sources of inflation is governments just printing extra money. And more money that goes into the system, that causes the supply of money to go up, and therefore prices go up as well. So gold really protects you from that debasement of your dollars. It's not necessarily a pure inflation hedge, but it is a way to protect you against one source of inflation.
What about private equity? As we see, like, geopolitical tensions are heightened as we move further into 2026, AI growing as well. Like, how is private equity important for this year and for investors?
Yeah, I think private equity could be one of the most interesting ways to think about AI implementation in client portfolios, not just because it could be focusing on the AI winners, but the private equity model is really to buy an inefficient business or less efficient business, maybe add some capital to it from debt financing. And then the next thing is go look for productivity gains inside of that business. Well, AI is a great way to enhance your productivity gains and therefore increase the value of that business. So today you get to enter a private equity market, which is relatively cheap to public markets, but you get to kind of play that AI productivity gain process as well.
Okay, Stephen Harvey, Chief Investment Officer at Sagard Wealth. Appreciate you coming in and joining us. Thanks so much.
Thank you.
Coming up, it is Hot Picks. We are zeroing in on 3 plays in small caps right after this. Stay with us. It's time for Hot Picks. Today we focused on 3 small cap plays, and we were joined earlier by Nathan Moser, Senior Portfolio Manager at Impacts Asset Management, and we kicked things off with why he likes the small cap space as a whole.
We are seeing a better start for small caps this year. It's been an even longer run than you suggested in terms of small cap underperformance, really going back more than a decade. And as a result, the asset class just got too cheap relative to large cap. And excuse me, and we expect that this reversion trade that you're seeing so far to start this year really has some legs to it.
Mm-hmm. And why is that? Just simply people, well, they've made a lot of money on these big US big cap techs in particular. I think people are worried about the capex being overdone in the sector.
Well, that's definitely a concern in markets. There's the chance that as CapEx gets pulled back, that you start to see some folks wonder about what's next. Really, the issue is you have extreme concentration in the largest companies in the S&P 500. Valuations and expectations have gotten to levels that we think are ripe for some reversion to the mean. And so that money, in our view, doesn't necessarily have to leave the market. We think it just moves down market cap. It moves to non-U.S. regions. And so that's what we're seeing. Maybe one last point about why we're so positive on small caps. When we look at the relative valuation of small versus large, we're back to levels we haven't seen since the late 1990s. So we're effectively at 25-year lows. And so there's lots of runway for small caps to perform better going forward.
Let's get into your ideas here. Acadian Asset Management, a quantitative money manager, just won a huge mandate from a British player?
Yeah, that's correct. Acadian is a very well-respected quantitative manager, superior investment performance with respect to their strategies. As a result, we're seeing very strong inflows into Acadian. You referenced St. James Place. They just awarded a mandate to Acadian for nearly $17.5 billion US. That's about 10% of the assets under management. So very impressive growth. We think that continues in the future. And investors really aren't paying much for such a high quality business. It trades at about 10 times earnings. We think that's too cheap. And as you see in some of the news today in the asset management space, consolidation is a theme that is taking place, and we think the value of Acadian is materially higher, both on a standalone basis and if they were to pursue selling the entire firm.
What deal are you referring to, sorry, in asset management?
Yeah, so the proposed acquisition of Janus Henderson by Victory Capital.
Yeah.
And again, that's just a proposal. That's not a done deal.
Yeah, thanks for reminding me. Eastern Bank, also based in Boston. What attracts you to this name?
So we like the Boston region just in terms of its economy. Eastern has been around for in excess of 100 years, not that long as a public bank, but very strong community relationships, very strong deposit market share. We are really excited about the company's shift from being acquisitive. They had done several smaller bank deals to essentially saying no deals in the near term and really focusing on driving profitability and returning excess capital to shareholders. So the stock has started to perform better. We think there's more room to run. It trades at a high single-digit multiple of earnings. They do have an activist investor in there that is agitating for them to sell the bank. And while that's not necessarily in our base case, I think it represents the compelling value of Eastern Bank.
And then finally, is it SciBone? They're a medical device company focused on pain, joint fusion in part. So it's spine technology.
Yeah, so it's SciBone, a smaller, very innovative medical device company focused on the lower back, specifically the sacroiliac joints. That really has to do with lower back pain. And what they've done over the last several years has really been impressive. They broadened out the product lineup. They have strong reimbursement. They've been investing heavily in their distribution capabilities. And, this is a circumstance where the fundamentals have improved materially, but the stock price has not. And so I think it's giving investors a chance where the market, and while I'm always one to respect the wisdom of the market's a bit short-term focused on this. I think they're missing the long-term value creation that the team at SciBone is creating. At Impacts, we're long-term investors. We're not going to focus on the market gyrations. We're going to focus on the destination. And the destination for SciBone is a much more valuable business than is represented today.
That was Nathan Moser, Senior Portfolio Manager at Impacts Asset Management. We're seeing an interesting split in the markets. While the traditional S&P 500 is trading lower, its equal-weighted counterpart is actually up, fairly strongly so. And that's not just a one-day story. So for more on the trend, let's bring in Bloomberg's Michael Regan to break it all down for us. Hi, Michael.
Hi. Thanks for having me.
Thanks for joining us. So this is a trend that started in the fall. It's continued into the new year. How big is the divide now between the regular and the equal-weighted S&P 500 getting?
Right. So if you go back to when the technology sector of the market peaked at the end of October, the S&P 500 itself, the traditional market cap weighted index, is basically flat, unchanged over that period, those 4 months almost. The equal weighted version is up about 8.5%. So a pretty remarkable outperformance for basically two indexes tracking the same 500 stocks over about 4 months.
So interesting. I mean, what does this suggest, do you think, about what's happening below the surface in the markets?
I think, I think the cap weighted index sort of obscures the fact that really most stocks have been gaining. If you look at today, twice as many stocks were up in the S&P 500, even though the traditional cap-weighted version index was down. That's the same, roughly the same year to date as well. I mean, I really think it speaks to the sort of rotation we've seen out of big tech into other sectors in the market. You really have this sea change about how investors are thinking about AI. On one hand, they're worried about the companies that are going to be disrupted by it, the software companies and the financial intermediaries, that sort of stock. But at the same time, it's such a competitive space that investors are also worried that the big tech companies spending hundreds of billions of dollars in capital expenditures, whether they'll truly get a return on that investment from all that CapEx, even if they are engaged in what is a revolutionary technology. It's a very competitive space. Some of the most important companies, Anthropic and OpenAI, aren't even public. So a lot of concerns that all this CapEx will not lead to the return on investment that investors really crave.
When was the last time we saw this sort of divergence, or have we ever seen this before?
You see it in bits and spurts here and there, but I think the one really notable time it happened to this extent, and even more so, was in that period in late 2020 into about early 2023. Now, remember, that was kind of a strange time for markets. The pandemic really caused a lot of different themes to emerge and loosen up sort of the big tech dominance of the index. You had the whole meme stock craze. So a lot of sort of retail investors chasing a bunch of different stocks. But ever since AI sort of became the focal point of the market in early 2023, we saw that outperformance really disappear, and the cap-weighted index that's so heavy with those Mag 7 and big tech stocks really dominate the returns for the next 2 years, at least until, as we said, around fall of last year.
And just lastly, I mean, is this rotation away from big tech temporary, or is this a longer-term shift?
Yeah, really hard to predict, obviously to predict the future. I mean, one thing I keep thinking, though, is that, big tech has forever been sort of the driver of the stock market, this century at least. So I think after a period of normalization, it would be surprising, at least to me, to not see big tech once again reemerge as leadership.
Okay, we will leave it there. That's Bloomberg's Michael Regan joining us. Michael, thanks for that.
Thank you.
And thank you for joining us today on The Close. We will see you tomorrow.